In this video, we're going to be going over what this pizza can teach us about Apple stock. So last Thursday, Apple announced that it was doing a 4-for-1 stock split, and the stock market went a little bit crazy. I think it's because it's not a very popular thing anymore, and so people aren't used to it. But let me explain exactly what that means, why they did it, and what that means if you own shares or want to buy them. Honestly, there's a lot of misinformation and even news outlets that are saying things that are pretty misleading. Let me read you something that the Wall Street Journal put in one of their articles about this stock split. They said, Apple Inc. said Thursday that it would enact a 4-for-1 stock split, essentially giving investors 3 more shares for every one they own. Now that is very misleading, especially just to the average person who's reading that article, because if they own 1 share of Apple, they might think that their shares are going to quadruple after this stock split happens. However, that's not exactly how it works. Now you see, this $3 pizza that I bought at Publix because I was too lazy to make my own can show us a lot about the stock market and about this stock split. You see, this pizza right here represents 1 share of Apple stock. And it's trading right now at about $427, but for the sake of this video, we're just gonna call it $400. What happens in a stock split is your 1 share turns into 4 shares. And so if you listen to what that Wall Street Journal article said, you would think that this pizza would turn into 3 more pizzas, and then you'd have 4 pizzas, which would be worth $1,600. However, Apple's not just going to give every single person who owns one of their shares an extra $1,200 or an extra 3 shares. That's not how anything in life works. So this is what happens. Your 1 share of Apple stock gets cut into 4 equal shares of Apple stock. And so now this whole pie is still worth $400. However, each of these individual pieces right here is only worth $100 each. So instead of having 1 $400 share of Apple, you have 4 $100 shares of Apple. Now that's what's known as a forward stock split, and that's what Apple is doing, and we'll get to why in a second. But if they wanted to do a reverse stock split, they basically take all 4 of these pieces and just put it back together. And instead of having 4 shares of a $100 stock, you would again have 1 share of a $400 stock. Now let me cut this a little bit more so I can eat while we're making this video. This is going to prove very necessary. So a little bit about the history of stock splits. They've been around since the stock market has been around, and companies used to always do them once their shares got over $100, up until about 2000, because around 2000 is when these big tech companies and internet companies started to take over the stock market and really gain traction, and they didn't really do as many stock splits as companies had before them. The reason these companies would do that is because once their shares reached $100 per share, they would do a 2-for-1, 3-for-1, 4-for-1 stock split and lower that price back down so that investors who were smaller retail investors could buy those shares at a lower price point. And that's the key. The market value doesn't change at all. However, investor perception changes a lot. And just like companies have been doing this for a while, this isn't the first time that Apple is doing a stock split. This is actually their 5th. They did a 2-for-1 stock split in 1987, 2000, and 2005. They did a 7-for-1 stock split in 2014, and now they're doing another 4-for-1 stock split in 2020. So that means that if you owned 1 share of Apple before they did their first stock split in 1984, your 1 would turn into 2 in 1984, your 2 would turn into 4 in 2000, your 4 would turn into 8 in 2005, your 8 would turn into 56 shares in 2014, and then those 56 shares would turn into 224 shares after they do this stock split, which is scheduled for August 24th. Now, over that period of time, if you held that 1 share that whole time, it'd be worth the exact same as if someone after August 24th, actually August 31st, but we'll get to that in a second, had bought 224 shares of Apple. So the exact details of this stock split, like we've already said, is it breaks your 1 share of Apple down into 4 shares, and that happens on August 24th. However, it's not actually going to start trading at the new stock price until August 31st. So after August 31st, you can buy it at the reduced price, which will probably be around $100 to $105 then. Now, this will affect the dividend as well, and it'll just get divided by 4 as well, more than likely. However, dividends are declared quarterly, so they'll really decide next. Right now, the dividend is 82 cents, and it'll probably be close to 20 to 21 cents with the 4 new shares that you get, so it'll be the same value. But why would Apple even do this? And there's a couple of reasons that we're going to get into, the first being the newsworthiness, the second being the perception, and the third having to do with the Dow Jones Industrial Average Stock Index. So the first is newsworthiness. Obviously, whenever a company makes an announcement like this, especially a tech company, which traditionally don't do these type of stock splits, it's going to be in the news. And on top of that, Tim Cook, who's the CEO of Apple, was in congressional hearings, as well as earnings was reported last week. So it was the perfect storm to really come through this past week and have lots of news on your stock price, which means that there's just going to be a lot of eyes on your company, which can be a good thing, especially since Apple beat their earnings expectations last week. And then the second reason is for perception. And this is one of the reasons that Apple cites for doing this, as they say it's going to appeal to a broader base of investors. Now, traditionally, this would definitely be the case, because if your stock is $400, that means in order for someone to buy your stock, they need $400 to do that. And so if you do a 4-for-1 stock split and you lower that price to $100, now someone needs a quarter of the money in order to buy your stock. However, that kind of falls through the cracks when you look at what a lot of brokerages are doing right now. If you look at Charles Schwab or Fidelity, or really most of these brokerages that are tailored more to the retail investor, they now have what are called fractional shares. And I won't get into that too much, but essentially it means that you can buy a fraction of a share of one of these companies for as little as $5. So instead of needing $400 to buy a part of Apple or $3,000 to buy a part of Amazon, you really only need $5, and you can still invest in those companies, and the percentage gains that they get, you'll be able to realize in your portfolio with your smaller amounts. However, there still definitely is an air of truth to that, because if you look at your portfolio and you saw that the stock price yesterday was $400 and today it's $100 and you like the company, some people are just going to buy shares just because of that. And to be completely honest, it seems much more attractive, at least on the surface, to buy a stock that's $100, that's a good company, versus a stock like Amazon that's $3,000, that's a good company. However, Amazon really isn't trying to target those retail investors, whereas it seems like Apple is. The third reason that Apple is doing this has to do with the Dow Jones Industrial Average, which is a stock market index. And this is where things get a little bit interesting and a little bit nerdy, so stick with me if you want. So the Dow Jones Industrial Average is a blue chip index of the stock market. Basically what that means is it tracks 30 of the biggest companies that are seen as relatively safe investments because they've been around for a long time, have a history of being profitable and having earnings. Now this index, and when I say index, just think basket of stocks. So it picks from all these stocks and puts them into this basket and tracks it. This index is price weighted. That means that for every dollar that one of the stocks in the basket increases, the Dow Jones Industrial Average is going to increase by $1. Now this is different than most of the indexes like the S&P 500, which you've probably heard of because it's the most popular of these indexes in my opinion. And that one is percentage weighted. Now the reason that we're even talking about this is because Apple is in both of those indexes, the S&P 500 and the Dow Jones Industrial Average. But the important thing is that they're in the Dow, because only 30 companies are in that, and of all of the big tech companies, the only other one that's in that is Microsoft, because most of the other companies haven't been around long enough in order to get into the Dow because they're not seen as safe as these two companies are. And another reason why this is really important is because Apple right now, like I said, is trading above $400 per share, while the next biggest company in that index is trading only around $300. So because Apple has a price of above $400 and the next biggest company has a price of around $300, for every 1% that Apple goes up, it takes the next biggest company almost 1.5% to increase at the same level. That means that Apple weighs way more heavily in the Dow Jones Industrial Average than all the other stocks do, which means that if Apple goes up or down, it affects that index way more. That is not necessarily a good thing in a blue chip index like the Dow Jones Industrial Average, because it might make it seem like it's more volatile, which is one of the other major reasons it would seem that they're doing this stock split, because changing that price to be more middle of the pack is going to mean that there's less volatility in the Dow Jones Industrial Average, which might make more institutional investors and people who want to have a more diversified portfolio without all the volatility like it more. However, if we're just talking about the S&P 500, this doesn't really matter because it's a percentage weighted index. So it doesn't matter whether the stock price is $4,000 like the largest stock in the S&P 500 or $400 like Apple. The movement of one of those stocks is going to affect the index in the same way. So should you buy Apple now because of this stock split? Well, if you look at what happened when they announced the stock split, the stock price went up 6% in after hours trade. Now, like I said at the beginning of this could be a multitude of different things because they had a good earnings report as well as announcing this stock split. However, historically, stock splits have been pretty good for companies. Now, I'm not going to tell you what stock to invest in, and you definitely have to do your own research before you get into any of these companies. However, just knowing what a stock split is going to help you along the road as you see other companies doing similar moves, and now you'll be able to evaluate them as the reasons why. Because, as you know now, it's in order to help the perception of the stock. It seems cheaper even though it has the same value, and it's going to help the indexes that the stock is a part of potentially, is one of the reasons why they do this. However, if you are investing in whole shares instead of fractional shares like Fidelity and Charles Schwab, like I talked about earlier, it is going to be a little bit easier for you to get into this stock because it's going to be a quarter of the price now. And another benefit of this, if you do want to purchase this stock or you have it in your portfolio, is once this stock split happens, if you want to sell whole shares in order to diversify your portfolio, you don't have to give up as much of your stake in Apple to do so. Because as you see now with this pizza example, we still have 2 of the $100 shares left, but 2 of them are gone. So let's say we sold those in order to buy another awesome company that we put into our portfolio, but we still own $200 worth of that Apple stock that we originally had, which before the stock split wouldn't be something that we could do without fractional shares. If you guys have any questions, leave them down below and I'll be happy to answer them down there, as well as in a follow-up video if you guys want. Subscribe while you're down there, and if you want to see me in the next video, click right here and you'll learn the best way to budget without hating your life. Thanks.